it does make a difference if you can only get 40% return compared to the 100 or even 80%. So I definitely think it impacts decisions, and I don't think it necessarily hurts.
You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to and watching the Financial Survival Network. I'm your host, Kerry Lutz. Well, we're almost at the end of March. And do you know what comes after March? April. And do you know what comes smack dab in the middle of April? Yes, you'd like to forget it, just like I would always. But we're talking about tax time. And, well, as you know, there's a lot of pitfalls, a lot of complications, a lot of things that you need to be thinking about here. And my next guest can help you. Anne Gannon, CPA, and does a lot of advising and tax prep for real estate investors, short, long-term, any kind you can think of. And it's great to have you on the show.
Yes, thank you so much for having me. We're excited to be here.
Great. So taxes and real estate, what's the biggest mistake that real estate investors make concerning their taxes?
So I think it's treating it, as it were an asset class, like really tracking it. I think the key with real estate investing, like anything else, is you have to know the rules. And, on the tax side, they are different depending on what you're investing in and how you're investing in that. So I think, where we start with a lot of our clients is just to make sure they understand the rules. My goal, whether it's with business owners or real estate investors, is just to give them back control, right? Like, you shouldn't have to wait for me to give you all the rules, but if I can educate you on the rules of the game, then you're able to make better investment decisions. So, that's really my goal.
Mm-hmm. So what do you think the biggest mistake, though, that they're making that's costing them money?
I mean, I would say probably just paying attention to how it's getting reported on your tax return. I think for a long time, real estate was just sort of one of these things that no one really knew where it was, or if they did, it's on that Schedule E, no one really looks at it. But I think then you go for a loan or you go to buy another property and then you're asked all these questions. And especially when you look at the categorization, so many times I've seen people get hung up, whether it's through a lender or trying to buy another property, because, their improvement on the property was put in as repairs and they just didn't, the CPA didn't really care, or wasn't told, or it was just tracked that way. And there's a huge difference between, capital improvement and repair. And a lot of times, all those analysis things that are done, it makes a difference. So I think just paying attention to how it's getting reported and making sure that's the right story.
So how do you stop them from making that mistake?
To not get into the busy season approach. So my goal with our clients is to really make sure that we're paying attention throughout the year, that we're looking for the end of the year, so when we get to this year's return, we don't have any surprises. But I think as the owner, don't be afraid to ask your preparer questions. I had a guy who came to us just this year and he couldn't get a mortgage on a second property because someone put the new bathroom in as a $20,000 repair. And lenders, if there's a repair, they think that's every year. They think, oh, if it had $20,000 last year, it's going to have $20,000 next year. They don't know. So if you don't have them in the right bucket, right? So, but an improvement is looking at, that's an improvement. You invested in the property. So ask the questions if you're not sure what those forms look like.
And from a tax standpoint, so some things you can write off right away. Other things, you have to do it over a period of years, right?
Right. And we're not in 100% bonus depreciation. So yes, there could be a difference in the return, but in his return, there wasn't. It didn't really matter because he couldn't take advantage of the loss anyway. So again, I think having that discussion before the return is filed, makes a difference.
Okay. So about that, the bonus depreciation and all that, what you're thinking as far as where the tax situation is going to be?
I know. I mean, I think nobody knows. A lot of what I've read is just that midsummer, there should be an answer. I think the thought is that, the hope is that 100% comes back. I mean, otherwise we're in a 40% bonus, which is not very beneficial to most people doing projects, where last year it was 60, before that it was 80. So I think the thought is that this year they have to do something on a lot of these rules. I think the other thing that's up at the end of this year would be the qualified business deduction. Yeah. Anyone who the pass through, that could go away. So I think there's a lot that's on the table for this year. And, hopefully by the middle of the year, we have an answer.
Got it. All right. So let me ask you a question about the bonus depreciation and all that good stuff. How big a deal was that for the real estate community? And what do you think the effects of providing it were?
I think it's a huge benefit. I mean, I think even you can see the difference between being in a 40-60 to a 60-40, that it does impact decisions. And, I think from a tax standpoint, it's the same pie. If you have a $100,000 asset or $1 million asset, you're going to depreciate it over the life of the asset. So it's really the same piece, but if you're able to give people more at the beginning, it does really match to the cash outflow. So you are incentivizing people to reinvest. So I think it is part of the decision maker. A lot of our investor clients, real estate investor clients, larger construction clients have said that they're kind of waiting because, it does make a difference if you can only get 40% return compared to the 100 or even 80%. So I definitely think it impacts decisions. And I don't think it necessarily hurts the tax picture because they will get less in future years, right? You're going to pay more tax in future years because you paid less this year.
So a lot of your clients were doing cost segregation studies?
Definitely more now that we're in the, 40-60 split. And especially for people who are in the short-term rental space, because their useful life is 39 years, whereas residential is 27 and a half. So, that's a huge swing to go from year 1 to year 39. So yes, I definitely think that it has pushed more people to know what cost variations are, where when you're at 100%, it doesn't really matter.
So if you're doing short-term rentals, you can't depreciate it like it was residential real estate then. Did I get that right?
Yeah. That's one of the rules that people need to really make sure they understand, that the short-term rental is treated as it's in a business category. And so it's not considered a residential for the property for the useful life. Yeah.
Interesting. So, which I did know that at one point. So you're like Airbnbs and all that stuff.
Yeah.
Are investment real estate. They're not considered residential.
But on the flip side, they go against ordinary income in a lot of cases. If you hit the 4 criteria that the IRS says for being a business, right, it can offset ordinary income, where a lot of real estate is considered passive and does not offset ordinary income.
Right. That's fascinating. All right. So, hey, do you have like a checklist or something that you give your clients?
Yes.
Would you be willing to send that out if people send?
Definitely. Yes, I will send that to you.
Well, good. So why don't we do this then? Hey, appreciate you coming on, and why don't you give us your email address? Tell us your website, so you'll send your free checklist, which will be real helpful to you because you should always have a checklist when you're doing taxes. So your email address, Anne?
Yes, it's agannon@thelargogroup.com.
Okay. And the website's largogroup.com?
Oh, largogroup.com, yes.
Excellent. All right. And if you got a question, you can always send me an email, kl@kerrylutz.com. We'll have a link to Anne's site, to the Largo Group, in the show notes to this interview on financialsurvivalnetwork.com. Just go there, click it, take you right there. And what we ask is, when you're on the site, please sign up for our free newsletter, like over 75,000 of you have done. Yeah, that's right. We're up to 75,000. And thanks for coming by. Talk to you again soon.
Thank you so much. Thank you.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.